Welcome to Key Points for the month of August. This month, why we think the Chinese slowdown will be contained, why we think corporate earnings will be strong and remain so, and why we think EM equity markets are poised for a rebound. Now to our first point. There's been further speculation, is China going to have another economic hard landing? Something we've touched on many times, and once again we're saying the answer to that is no. There is no doubt some of the data coming out in the early summer have been a bit weaker. We see that in terms of infrastructure and aggregate lending. But one should remember this has been largely by design. The Chinese have acknowledged they have a shadow banking issue, too much credit, and they've been implementing measures to contain that, and indeed they've done so perhaps a little bit too well. Now the good news is that we're seeing both some fiscal and monetary initiatives being deployed. And as a result of that, we think the Chinese economy will stabilize and actually growth may even pick up a little bit from here. But it should be remembered, in aggregate, the Chinese growth rate is likely to be declining slowly as they focus more on the quality rather than the quantity of growth. Now to our second point. Corporate earnings we think are going to be good this corporate earnings season for Q2. And importantly, we think as we look out for the next 1 or 2 quarters, they will remain pretty robust, we think, for most of the key regions. In the United States, what numbers we've seen so far are suggesting that Q2 will be another 20% plus year-on-year earnings period, again following on a similar type level from Q1. Corporate profitability is strong, and the aggregate macro backdrop is such that we think that revenues and margins will hold up pretty well. But it's not just in the US. Importantly, we're seeing European corporates reporting or starting to report good numbers, and in Japan as well. And that's something that, as I said, we think for another quarter or two will remain pretty robust and should support the bull market in equities, allowing investor sentiment to remain fairly robust. Now to our third point. EM equity markets have had a fairly torrid time the last 6 months, and indeed that period has seen some of the, or actually the third biggest outflows since 2002. So investors really somewhat disenchanted with EM having been very bullish in them only about 6 months to a year ago. Partly, of course, that's been a function of the Chinese slowdown. Partly it's a function of worries about the impact of tariffs and trade. But the good news is that we think there's some, again, stability here, and we think that Asian equities in particular, EM, are poised for a bit of a rebound. Why do we think that? Well, looking at some of the key indicators such as exchange rates, cross-exchange rates versus the dollar, which had been moving quite substantially, forcing some higher interest rates, again, has settled down. And when we look at base metals, another good indicator of optimism for the region, they've also shown stability as well. So net-net, we think that after a very torrid period, they're due for a bit of a pickup, but longer term, they'll still have the higher headwinds of a tightening interest rate environment more globally. Remember, the full details of this report and everything I said can be read with all our publications on www.zurich.com/MSME.